Hi there, welcome to my channel. My name is Gloria Adelie. I'm popularly known as the Fifth Grabbing Chick, and in today's video, I'm going to be walking you through analyzing a market trend. One of the mistakes a lot of traders make is believing that they can trade against the trend. They can try to outsmart the market by moving against it. Now that is fundamentally wrong, because as far as trading goes, you must always move in line with the market, because when the market is moving in the buy direction, it just makes sense for you to be moving in that direction, because you are here as a retail trader to profit from the market movements, the market opportunities, and all of those things that you see the market moving. So some people tend to understand this basic principle that when the market is trending towards the downside, you trend towards it. Or when the market is trending towards the upside, you trend towards it. But the question they always ask is, okay, at what point should I enter the market? At what level should I take a buy from? At what zone should I take a sell from? Because the market has already moved. So how do I know when to move with it? That's the reason why some people, the minute the market moves in a particular direction, you see them jumping into it, and then the market takes them into a loss, drops, and do all of those things that will make them lose money. So in this video, I'm going to be making it very simple, breaking it down very simply, that is analyzing a market trend. Remember, this is a channel where we focus on releasing educational videos as far as trading the naked chart goes. As you can see on my screen, this is completely a naked chart. I seldom use indicators, as you would come to realize when you check all the videos on my channel. I seldom use indicators. I mostly use pure price action and market structure. So in today's video, we will be analyzing the market trend. In your basic Forex trading, you've learned that the market can move either of three directions. The market could move towards the upside, which we call the bullish trend, or the market could move towards the downside, which we call the bearish trend. So when the market is moving towards the upside, we call that a bullish trend, an uptrend, a rising market, call it whatever you want to call it. And when the market is moving towards the downside, we call that a bearish trend, a selling market, a falling market, etc. And when the market is consolidating or ranging, we call that a sideways market. So this is basically how the market will move every time, every day, every minute, every second, every year. Like, it doesn't change, it remains the same. So knowing that the market can only move in either of these three directions just pretty much puts everything into perspective. It just pretty much tells you that as a trader, you are looking for opportunities within this move. So for a market that's moving towards the upside, you already are prepared to look for buy entries. When the market is moving towards the downside, you are already prepared to look for sell entries. So the question most people always ask is, where do I enter from? Now I'm going to tell you straight up that when a market begins to move, will be the wrong time for you to jump in. As the market has already started pulling up, that's not the time for you to jump in, unless you were amongst those who saw the beginning of that move. It's always best for traders to wait for the market pullback, to wait for price retracement, and all of those things that happens that puts you in a better position to take a trade. Kind of like see it as you seeing a particular commodity you want to buy, or let's say you want to buy something, say a shoe, a bag, or something, and then you hear that there is going to be a sale at a particular time. This thing just came out, so it's hot, so they are putting it's expensive. So then you hear that, okay, it's very possible that by the time people buy and then the hype reduces and all of that, you start seeing that the market will start coming down, you start having sales, there will be price slashes, and all of those things that follows products like that. So bring that same understanding into the market. When you say the market pulling up, pushing up, that's not the time for you to now start jumping in. You always want to make sure that you wait for a better price, you wait for a bargain, you wait for a price slash, you wait for sales. So how do you do that? It is by catching the market at a strategic point. In one of my videos on the Fibonacci, I said one of the best points that you can begin to target entries for joining the market trend is by by using the Fibonacci retracement tool. Now, the reason why you want to use that tool is that it helps you target strategic price zones or price levels, or even levels of support and resistance. So say you've seen this market move and the market has already peaked from this point. You're wondering, should I jump in from here? Some amateur traders will jump in from here, some will jump in from here, rake a few pips and all that. And all of those things that some people do that puts them at a very high risk level. I see some people, they see a market that's already done this, and I see them jumping in, right? And then as they jump in, the market pretends like it's going to go, and then it starts pulling back, and it goes up again, then it pulls back, then it goes up, and then they're anxious, they're stressed, they're worried, they're afraid. Wouldn't it make more sense for you to catch the market price at a point where it will be beneficial for you, it will be profitable for you? I think it will make more sense. So what is one way you could do that is by using the Fibonacci tool. So that is what I'm going to do in a very few minutes by going into a real trend and analyzing it. So what have we learned now? Just this first point. When you see price impulses or the market pushes up, wait for a pullback. Always wait for a pullback. Always wait for a retracement. Always wait for a reduction in price, because by so doing, you will be able to capture price at a better entry point and at a better rate. Because if you're jumping into the market when the market has already started moving, you just might enter at the wrong time, because this whole trading and this whole Forex of a thing is just all about entry. Two people can take a trade, one guy buys, the other guy sells, and both of them will make profits. I mean, look at this. When the market buys, it sells. It buys, it sells, because that's all the market can do. It will only buy and sell. It can't do any other thing else. It buys, it sells. It buys, it sells. So it's just that continuous buy and sell, right? As the market is buying and selling. So even in a bullish trend, there are sell opportunities there. Even in a bearish trend, there are buy opportunities there. So one trader buys and another one sells. Both of them will be profitable, right? Now, what will make them profitable? The point at which they entered from. So a trader buys the selling market and he makes profit. Another one sells the selling market, he makes profit. What differentiates both of them is what their entry point. A trader can even buy a selling market and make profit, while another one sells the selling market and you hit stop loss. Why? Because the entry. So it's just all about entry. So every strategy, every whatever it is you want to bring into the market is to help you target a very better, clean entry. So that's the reason why I always believe in studying it into the, like, going deep into the market. Understand the psychology behind market movement. Understand the psychology behind price action. Because when you're able to do so, you put yourself in a better position to profit. And that's one of the things we do in all our master classes. We go into the market by trying to understand the psychology behind market movement, psychology behind price action. So in the next couple of minutes, I'm going to be opening a chart, and then we're going to study the trend, and then we're going to use the Fibonacci to spot an entry. So this right here is a market clearly trending towards the downside. So you've come into the market, or let's say you were looking for sales opportunity. Personally, for me, because I trade the M's and W's, I would have caught the sell, right? I'd have caught the sell. So say you didn't catch the sell, you missed it. You missed the sell. Now, it will not make sense for you to now start trying to run after this sell, because what is the guarantee that the point you enter from, the market will continue selling? As long as the market continues in that straight line, it continues to move continuously down that path, it will not make sense for you to jump in, because jumping in will be you trading a higher risk trade. Your opportunity for profit is now on a 50-50 probability scale, because you might hit profit or you might just hit stop loss. So it's a lot better for you to see an actual pullback before you begin to trade this. So what would I have done if I had seen this opportunity? I would have sold this, and if I didn't see the opportunity, I'll wait for a pullback. So waiting for a pullback will give me a better place to enter the market from, because that tells me that the market has, sustainably moved in a direction. Now it's trying to catch its breath, and now it's trying to pull back. That's what makes Forex fun, being able to see the market trend. And how will the market trend? By pushing and pulling back, impulsing and pulling back, impulsing and pulling back, moving and pulling back, thrusting and pulling back, however you want to call it. So all of those pullbacks create opportunities. all of those retracements create opportunities for you as a trader to spot an entry. So when you see that market has already started moving, don't feel like you're missing out. Wait for a pullback. So that's what we've seen here. First market move and then a pullback. So what are we seeing after that pullback? Market continuation. Here's another pullback. Market continuation. Here's another pullback. So all these pullbacks are levels of entries. These are your best levels to enter the market from, right? Because if you're trying to catch this move, you might jump in here and then the market buys, hit your stop loss, and then you're trying to jump in again, you're jumping in, you're stressed, right? So it's a lot better for you to see that clear continuous pullback, then you take it. So you miss this point, your next best point would be at the pullback. So how will you now target that zone? The Fibonacci will help, bringing it out and targeting levels of retracement. The popular levels of retracement are often the 38.2 to 50%. But personally, I don't trade those levels because they are very popular, and with this forex market, popularity is not your friend. So you want to make sure that you're always trading when there are like very few people. So I mostly target the 61.8 to the 78.6 zone. I don't target the 38.2 to 50%. So I would have missed this opportunity and all that, right? I would have missed it because this is not my zone of entry. But some trader would have seen this opportunity and catch the trade. So what are we trying to say? We're trying to say that as the market is trending, it's creating opportunities for entry. So it's a lot better for you to enter the market after the pullback or after the retracement. That way you don't jump or run after a moving trend. Alright? That's the better strategy. That's the best way that you will trade. So what other thing can we learn from the trend? Other than trying to enter the market when the pullback, another thing you can see, study from the trend is the market levels. So as the market continues to trend, create levels. In one of my videos where I talked about market levels, I did mention that the market could, continue to move in a particular direction, maybe creating three levels or 4 levels or even 5 levels. The minimum is often 3 levels, right? So as the market continues to move in a particular direction, you want to see a minimum of 3 levels. And when you begin to see that minimum of 3 levels, it's telling you now that the market is approaching a point where the trend just might become exhausted. The trend just might become overflowed. So seeing a trend that has been sustained for a long period of time, and you still trying to join that trend, will not really be wise. It's not better for you to catch a trend at the earliest stage. That will give you more opportunities for profit than you trying to catch a trend that is already at the exhaustive stage. So say you are looking at a trend like this one, for example, and you see that the market has considerably moved more than 3 times. Looking for a sell at that point would be risky. So look at this one. This point where it begins from, it's kind of like the beginning of the movement. So we call that point 0. This point right here is point 1. So this point right here, that's point 0. This point right here, that's point 1. The market drop pushed up again and created point 2. And you can see that point 2, they all have the same highs, right? So they're all within that range of point 2. So this is level 0, level 1, level 2. The market dropped again, created level 3, and we saw the level 3 corrective created level 4. So already you can see that the trend is well sustained, right? So trying to catch a sell at this point would be putting yourself at a higher risk. So what are we expecting to see here? We're expecting to see the market reset. We're trying to see a reversal pattern. We're trying to see the market turn around, right? But does that mean that because the market is there, we'll just rush and buy? No, we need to see a reason for us to buy. We need to see a reason for us to analyze, actually see that this market is ready for a buy. So what we're waiting from here to see at this point is opportunities for buy. So until we see that opportunity, we don't buy this market, we don't sell it either. Why? Because the sell has been sustained for a very long time. So entering here for us is we're crashing the party, we're late to the party. So we're not looking for sales here, or we're looking for buy opportunities. So you can sustain a trend following it all the way down. Why? Because you just learned that 2 ways you can join a market trend. Join it at the onset, after the initial impulse, wait for the pullback. And how do you measure the pullback? Using the Fibonacci retracement tool, targeting the 61.8, 70.6 zone, and then seeing that the market because it's still fresh. So say you didn't catch that fresh move, but you see that the market has done a minimum of 3 levels, and then you want to be very careful, because most times the market moves 3 levels and then it turns around. Other times it can give you the 4th level, even other times it can give you the 5th level. But then again, the further in that the trend goes, the more risky, the more dangerous it will be for you to continue to try to move in line with that trend. Alright? So it's a lot sweeter, a lot easier for you to catch a trend at the onset. So in most of our classes, that's what we do. We teach students how they can become profitable just by studying the naked chart, studying the market structure, and targeting entry points that actually works. So check on the description section to see a way you can contact us and talk to us about beginning your Forex class. Remember, this is the channel where we teach you how to trade to profit. So if you've enjoyed this video, don't forget to like, comment, and share, and then, of course, subscribe to the channel. So I'll see you again next time. Have a good one.